Margin debt, we just got data out late last week, continued to its fourth record high north of the $1 trillion level in margin debt, as you can see on the lower panel of the chart that we're showing on the webcast now. Very interesting setup there. A lot of people are nervous about these highs in margin debt, but what we want to point out is increasing leverage is not necessarily a bearish event. It becomes bearish when unwinding starts. As you can see from the dashed lines on this chart, the unwinding on a monthly closing basis tends to precede the highs on the S&P 500. Look at what happened going into the 2000 peak from August of 2000. Peaked out in margin debt in March, market topped out in August, and it was lights out for a couple years. Look at October 2007. Margin debt peaked out a couple months earlier. One false signal was in 2011. But the S&P did struggle a little bit. September of 2018 was another one. The margin debt peaked in May of that year, and the S&P corrected nearly 20%, or 20% depending upon whether you're looking at closing daily prices or intraday daily prices. Then in 2019, ahead of the COVID peak, you never really had a new high in margin debt, but it peaked out in July 2019 on a lower high and then dropped. And then the last time this happened, you had a peak in margin debt in October. And then December, you had a peak in the S&P and a sizable correction into late 2022. Why do we think margin debt can go higher along with the S&P? The reason why we think it can go higher is it's not overbought based on its 12-month rate of change, which is the lower panel of the chart that you have up on the webinar now. You can see here you got higher highs and plenty of room to overbought on the 12-month rate of change. That tells us that margin debt should continue to move up and confirm rallies in the S&P.